Order! Order! You are an incorrigible delinquent at times. Behave yourself, man!
Stock markets around the world have plunged yet again, with traders spooked by yet another steep fall in oil prices. Brent crude slumped to its lowest level for 12 years after warnings that the market could drown in oversupply. The state of the markets hasn't been this rocky since the crash of 2008. Well, our economics editor Paul Mason is here. Paul, we talked about this yesterday. It was bad yesterday. It's worse today. Why?
We keep coming back because the momentum for the stock market slide is building. Let's have a look at how far off their peaks some of the major stock markets are.
Wow.
The FTSE in London, 20% off what it was in April last year. The Euro Stock 600, a big index of European stocks, 21%. And look at China, 42% off where it was in June last year. Now, these stock market slides begin to interact with what's happening in the real economy. The big thing that's driving it all down is China. The real slowdown in China is probably, we think, much faster than the official figures actually represent. And we're beginning to see it in things like the fall off of German exports to China. That leads to falling German growth. So day after day, what we call the news flow in economics points in the same direction. And investors, people with pensions, are just reacting by taking it away from where the risks are.
So given this sort of herd mentality that's beginning to manifest itself, fear, what can policymakers do about
Well,
this?
it's not policymakers' jobs to make those stock markets go back up. In fact, only in China do they even try King Canute-like, not with any great success. These are now bear markets, as we call them, markets that are destined to fall a bit more. But what we're now looking at is that the whole recovery for the last 7 years, probably driven mainly by loose money, low interest rates, and what we call quantitative easing, printing money. You either have to do a bit more of that, or you have to start biting the bullet and writing off the debt that is overhanging all these economies that are in trouble.
We'll speak some more in the next weeks. Paul, thanks very much. Now, the markets may be riled, but a record number of people are in work and unemployment is at its lowest level for a decade. The latest figures show that Britain's labour market is continuing its recent winning streak, shrugging off the woes of the global economy. But at the same time, wages are growing slowly, slower now than in the summer. So if labour is in such demand, why are our pay packets not getting any bigger, any faster? Here's our Home Affairs correspondent, Andy Davis.
This afternoon in the depths of a flavour factory above Ebbw Vale. 10 tonnes of powdered food flavouring and colouring are bagged up here every day. Industry laced with the essence of lemon and chocolate.
This is a chocolate emulsion that is made from a preset recipe. It is mixed together, then it's pumped through a homogenizer pump.
There are plenty of manufactured aromas here. There's the smell of success too. A workforce of 70, they took on 20 new employees last year, are about to offer workers a 3% pay rise and have plans to recruit yet again.
We're expanding again this coming year. We're going to take on 16 people, new machinery coming in. We're looking to take on 10,000 square foot in the next week.
So the labour market is thriving as far as you're concerned?
As far as we're concerned, we can't keep up with the demand.
Across the UK today, it was certainly a bright picture being presented of a jobs market in rude health. The latest figures reveal the employment rate at 74% is the highest recorded since 1971. There are just under 1.7 million people out of work. That's the lowest total for 7.5 years. As for job vacancies, 756,000, representing the highest figure on record.
And yet, despite all of this, if you look a little deeper into today's figures, the picture isn't quite as rosy as you might think, because in a thriving labour market, you might expect significant rises in wages, but that just isn't the case.
In fact, average annual earnings, including bonuses, were up just 2%, the slowest rate of increase since last February. In Ebbw Vale today, we did find one worker in the car industry hopeful of a better deal this year.
We had a 2-year deal, so we had 2.5% 2 years ago and 3% last year.
And what are you hoping for this year?
We're pushing for 4.
But it was a different story for others.
When was the last time you had a pay rise?
We had one last year, but it was the first time for about 4 years, I think. Yeah, we had about 1%.
What are you expecting this year?
Probably about the same, to be honest.
Obviously, prices and things of groceries, etc., have gone up. Same as your gas, your electric, everything have gone up, but not your wages.
You don't feel like you've got more cash in your pocket?
No, if only.
After years of squeezed wages, what we should be seeing, said one economist today, is a catch-up period where pay rises more quickly than usual to make up for lost ground.
It is quite surprising that that catch-up period has been curtailed so quickly, especially with employment numbers growing so strongly. And maybe that suggests that there's more underemployment, more hidden slack, people wanting more hours when they're in jobs that we need to use up to really get pay back on track.
In a week which has witnessed more huge job losses in the UK's embattled steel industry, not least at Port Talbot in South Wales, today's figures are undoubtedly good news. But with the global stock markets in turmoil, the resilience of this labour market revival may yet face real challenges in the months to come.
Andy Davis reporting.